Welcome everyone to Vested Interest. This is Shane back for a Stock Pick of the Day video. It is Thursday, March 13th. We're going to take a look at Williams Sonoma. This is out of the consumer discretionary sector. Before we get too far in the video, if you could do me a big favor, it doesn't take but a couple of seconds of your time. It is free to do, but it really does help out a small YouTube channel like mine with the YouTube algorithm. If you could drop a big thumbs up down below, hit that thumbs up button. Make sure you're subscribed to the channel. Join us on this journey to financial freedom. Click that subscribe button. Hit the notification bell so you're notified whenever I put out any new content. I do this Stock Pick of the Day video series Monday through Thursday whenever the market's open. We take a look at a company stock that's pulled back on the day, run it through the screener, and see how it stacks up and if it makes it onto my watch list. There's also the thanks button down below if you find any value in the content and you want to help the channel out. That is a way to do so as well. You can buy me a cup of tea and share with anyone you think that might find value in the content. And also watch time is one of the biggest ones for the YouTube algorithm. So if you could watch the videos to the end, that is one way to make sure the videos get out a little bit further as well. Really appreciate the subscribers and the viewers of the channel. You guys and gals are awesome. The channel continues to grow because of people like you. This is the Vested Interest Stock Screener. You can pause this, read through the criteria. This will be the criteria we are going to run through in the video. It's not all we're going to look at in the video, but it is the one that we will look at the end to see how it stacks up. Must meet 5 of 8 to make it onto my watch list. If it was a financial company like a bank or an insurance company, we would throw in price to book, and then it would be 6 of 9. You can use price to book for any company, just don't use one as fair value. That is really for banks and financial companies, like I said, insurance companies, for example. So you can use price to book for any company. Just make sure when you're looking at companies outside the financial sector, you are comparing them to their historical averages of the company you're looking at and comparing them to other companies in other sectors. Then that will tell you how they stack up. All right, back to Williams Sonoma. Check them out on their homepage, www.williams-sonoma.com. That's www.williams-sonoma.com, williamssonoma.com. That is their homepage where I pull this information from. And as you can see here, here's the founder way back in 1953. That was his first trip to Europe. Chuck takes a 3-month-long journey to Europe with friends. While there, he sees what French, German, and Swedish cooks are using in their kitchen and is inspired to bring the same high-quality cookware to America. So that's really where it got started, right? He wanted to bring that cookware to America whenever he took a trip over to Europe. So in 1956, he opened the first Williams-Sonoma store. You can read through that there. 1958, Williams-Sonoma opens in San Francisco. Since many of Williams-Sonoma's first customers live in nearby San Francisco, it becomes apparent to Chuck that a move to the city would allow him to better showcase the cookware he has discovered overseas. You can read through that a little bit more. That was in 1958. Fast forward to 2001, Williams-Sonoma expands globally. They expand not just in the United States, but outside the United States into Canada and then Sydney, Australia as well. They also sell online, so if you wanted to look them up online, you could find them there. That's what this homepage is down below. And last, there in 2013, the most recent update, Williams-Sonoma Cooking School opens. The first ever Williams-Sonoma Cooking Schools opens inside the Sydney, San Francisco, and Chicago stores. So what are they? They are really a retailer that focus on not just cookware. It's a lot of different products now. Cookware obviously is where they started. Cooking tools, cutlery, your knives, electronics, bakeware, food, tabletop, home essentials, outdoor and gardens, furniture, holidays, gifts. So they are focused around the consumer, and it's not just cookware anymore. They definitely have expanded out to home goods, outdoor and gardens, home essentials, those sort of things, but still have their bread and butter cookware where they started from. Now, the reason we are taking a look at Williams and Sonoma today, ticker WSM, again, out of the consumer discretionary sector, they were down 5.64% on the day. Big drop, closed out the day at $165.03. Looks like they were up slightly in the after hours, at least whenever I pulled this information. 52-week range as low as $125.33, as high as $219.98. I did own Williams and Sonoma at one point. I think I sold them around the 130 range, was buying them in the low 90s, sold them in the 130 range, and then they ran up very fast into the 200 range. So I wish I'd have held them a little bit longer, but that's the nature of stocks. Sometimes you buy and then you sell for a profit, and then they keep on going. And that's just another one that recently did that is Baba, right? But sometimes it's all right to take that profit. I would much rather be buying them back here in the 150 or 125 range than the 165 range where they currently are at. That would be about where I'd like them, 130 or less, but not quite there, and they've got a long way to drop. Not within 15% of a 52-week low, or really even close right now. Market cap of $20.315 billion, a beta of 1.81, so they are much more volatile than the overall market, right? And I'm hoping to use that volatility to my advantage. Love to be buying them back here at the 125 range. Not interested right here at 165. I think they're overvalued. PE ratio, price earnings ratio, $19.53. Earnings per share, $8.45. Earnings date coming up. Well, actually, it might have been today. Maybe that's what that drop was today. They're saying March 13th through March 26th. So somewhere in that window, but it could very well have been today. Forward dividend is $2.28. They are quarterly payers, so divide by 4. We'll see it here in a little bit, so you don't have to do the math if you don't want to. Yield is starting at 1.30, so a little on the low side, but obviously if you get them back here closer to 125, you could get them up. I think when I was buying them, it was around 2.2, 2.3%, so much higher than they are now. Ex-dividend date, January 17th. They paid out on February 21st, so if you were to buy them now, you would be in line for the next dividend, but you're going to have to wait a couple months to get it. 1-year target estimate, $183.85. So they see it going up from here over the next calendar year, but not quite back to its 52-week high. Well, actually, not even really close to its 52-week high. And if we had a prolonged pullback or entered a recession, companies like this will get hit hard, right? I don't know. A lot of people are going to be going out buying new cookware, especially if we have tariffs that hit, because some of this stuff is imported from overseas. So this company could get hit very hard if there are tariffs that last for any length of time. 185, we went over that. Now jumping over to the right, I like to look at the dividend yield theory. And to do that, we look at 5-year dividend yield average, 1.9%, compared to the current 1.3%, or over here, forward dividend, 1.3%. And since it is lower than their 5-year average, that speaks to overvaluation, at least according to dividend yield theory. These numbers are inversely correlated. So if this was higher than 1.9, let's say it was 2.2, 2.3, that would speak to undervaluation. But since it is lower, that speaks to overvaluation and significant overvaluation, at least according to dividend yield theory. Payout ratio is low at 25.49%. Doesn't look like they're in danger of cutting that dividend anytime soon. Looks like they've got plenty of room to continue to raise it. And that's what we like to see. I like under 75% for a payout ratio. I also like growing free cash flow over time. Typically, if a company has growing free cash flow, they can do some things with that cash flow. They can pay down debt, they can make acquisitions, reinvest back into the company, buy back shares, pay a dividend, which this company does, and raise that dividend over time. So going back here to January 2021, $1.1 billion in free cash flow, slightly up in 2022 to $1.14 billion in free cash flow, but down in 2023. $698 million in free cash flow, back up again in 2024 to $1.4 billion. So outside of that 1 year in 2023, looks like they're growing, but that was definitely a down year. Repurchasing shares as well. They're taking shares out of the market in 2021, $150 million. That was up in 2022, up to $899 million. And not only was their free cash flow down in 2023, they slightly dropped their repurchase of shares down to $880 million from $899, and continued that trend in 2024, only 313 million shares taken out of the market, but still nice to see they are pulling shares out of the market. Jumping over to stockanalysis.com, this is another source I go to for information. The previous slide was Yahoo Finance. I am not affiliated with either source, and I do recommend more than one source for information so you can make sure the information you are getting is accurate and up to date. Now, stockanalysis.com has 19 analysts that have taken a look at this. They call it a consensus hold. Low estimate of $116. Again, I'd love to be buying it back here at $116. I sold it for a little bit more than that about a year ago, so I'd love it to drop back down, and that would represent a 29.71% decrease from where it currently sits. Average estimate of $168.34. That would represent a 2% increase from where it currently sits. And if it happened to hit their high of $226, that would represent a 36.94% increase. And you could collect that 1+% dividend yield along the way. Jumping over to the right here, it's under statistics. If you go to stockanalysis.com, click on statistics, there's a lot of good statistics there, but the ones I like to look at for initial screener is return on equity and return on invested capital. I like 10% or better for both of these metrics. Return on equity at 58.86%, smoking high, very high return on equity, and return on invested capital, same thing, 26.76%, very nice to see. EPS growth, I like 5% or better forecasted over the next 5 years. They're looking at 9.88%, so above the 5% I'm looking for. Revenue forecast is at 3.12%. Let's run through the history real quick. Quarterly payer, as we mentioned, payout ratio again extremely low, 26.94. Dividend growth extremely fast at 26.39%. Growth of 10 years. Buyback yield is positive at 1.61%. So they are doing a good job buying back shares whenever they are relatively cheap. Shareholder yield is positive at 2.95%. They do pay out off schedule for most companies. February, May, August, November. So if you're trying to balance out your portfolio a little bit and get some payers on those off months, this would be a good one to look at if you can get it for the right price. Going back here to July 2022, you can see 39 cents in per share here. And April 2023, 45 cents was the raise up there. And then most recently, April 2024. Oh, actually, there's another one. So April 2024, they raised it up to 56 cents, some fractions of a penny. And I don't know if that's a raise or if they just rounded that up to 57 cents. July 2024, they're calling it 57 cents. So I would anticipate, looks like around April is whenever they make that raise. And if they're going to continue that trend, I would anticipate it again around April of 2025. All right, let's check out the screener and see if this one stacks up well enough to make it onto my watch list. Understand the business. That's where we started, right? They're a retail store that sells a lot of home cookware and home goods. Growing free cash flow. No, we had the one down year. Growing dividend. Yes. Double-digit growth, right? Almost 30% growth. Even if they maintained a 20% or more, that's very nice to see. Dividend payout ratio of 75% or less. Yes, it's under 30%. Check valuation based on dividend yield theory. Dividend yield theory says they're actually potentially overvalued and significantly overvalued right now by about 30% or more. Buy below current cost basis or within 15% of a 52-week low. It is not in my portfolio, so it can't be under my cost basis, and it is not within 15% of a 52-week low. Return on invested capital, return on equity, both over 10%, so check there. And earnings per share growth was over 5%, so check there. 1, 2, 3, 4, 5. It does make it onto my watch list. This is one I am interested in buying back into. If it was to drop back into the 120s, I would probably look to add it to my portfolio. Let me know what you think of Williams Sonoma in the comment section down below. Is it one you're looking to buy? Is it one that you hold in your portfolio? Is it one you are selling? Maybe you're part of the reason for the downturn today. All right, that's it. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. And drop a comment down below. Let me know what you think of the video. Let me know what you think of Williams Sonoma. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. So if you have a company like Williams Sonoma you'd like me to cover in the Stock Pick of the Day series, drop it down there and I'll try to work it into the rotation on a day it pulls back. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great weekend. And don't forget to come back here on Sunday. We will look at our portfolio update, what we bought for the week, any options we were in, any dividends we received. You'll see that then. I'm not a financial advisor. Nothing in the presentation should be considered financial advice. I'm only sharing my opinion. Investment journey for educational and entertainment purposes. Investing involves risk. You can lose money and never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor. And if you've made it this far, don't forget to hit that like button, share with anyone you think that might find value, drop a comment, hit subscribe, and hit that notification bell on your way out. Thank you. Thank you so much.